There's a number that changes everything. $100,000. Not because it's magic, not because it unlocks some secret investment opportunity, but because of what it represents. The moment when mathematics finally starts working in your favor instead of against you. And then I'm going to show you why the next 900,000 comes faster than you think. Why going from 100,000 to 1 million is easier than going from 0 to 100,000. Not slightly easier, dramatically easier. Most people never reach it. They spend their entire lives chasing it, getting close, falling back, starting over. And they never understand why it's so hard. I'm going to tell you why. This isn't motivational talk. This is mathematics, and if you understand it, really understand it, it'll change how you think about money forever. Let me start with a truth that nobody wants to hear. Your first $100,000 is a grind, a brutal, exhausting, demoralizing grind, and it should be. Because you're not just building wealth, you're building the infrastructure for wealth. The habits, the discipline, the systems, the psychological fortitude to do boring things consistently when everyone around you is chasing excitement. That's what the first 100,000 teaches you. And most people fail the test, and they lose every single time. I see young people today trying to skip this phase. They want to go straight to the million. They're buying lottery tickets disguised as investments, meme stocks, crypto with no fundamentals, options they don't understand, anything that promises to turn 1,000 into 100,000 overnight. So they chase, they panic, they switch strategies every month, and they never accumulate anything. The first 100,000 isn't about finding the perfect investment. It's about proving to yourself that you can save, that you can delay gratification, that you can ignore the noise and stick to a system even when it's boring. Not because those assets can't go up. Some of them do, but because they haven't built the foundation. They don't have the discipline to hold through volatility. They don't have the patience to let probabilities play out. They don't have the emotional control to stick with a plan when it's not working. It's a test of character disguised as a financial goal. Here's what makes it so hard. At the beginning, your contributions matter more than your returns. Let me say that again, because it's critical. When you're starting out, how much you save matters infinitely more than what return you get. If you have $10,000 and you earn 10% in a year, you made $1,000. That's nothing. You can save more than that by cutting expenses, by working extra hours, by being disciplined about where your money goes. But people obsess over returns. They spend hours researching stocks, trying to pick winners, optimize their portfolio, squeeze out an extra 2%, and meanwhile, they're not saving enough. They're not increasing their contributions. They're focused on the wrong variable. The math is simple but brutal. Small amounts of money don't grow fast, even with great returns. That's just reality. I made this mistake early. I thought I was smart enough to pick better investments than everyone else. And maybe I was. But it didn't matter because I didn't have enough capital for it to compound into something meaningful. $1,000 at 20% annual returns for 10 years becomes about $6,000. That's good, but it's not life-changing. It doesn't create momentum. It doesn't feel like you're making progress. This is the wall, the psychological wall that stops most people. The phase where effort feels disproportionate to results, where you're saving aggressively and investing consistently, and the balance still feels small, still feels like it's not enough. So people get discouraged. They think investing doesn't work. They stop contributing. They give up right before the math starts working in their favor. You need to push through that feeling because something extraordinary happens at $100,000. 10% of 100,000 is $10,000. That's real money. That's a number you can feel. That's what you might save in an entire year. Now your money is working as hard as you are. The returns start mattering. At 200,000, 10% is 20,000. Now your money is working harder than you are. It's earning more in a year than most people save. And it's doing it automatically. While you sleep, while you're at work, while you're living your life. But you have to get there first. And getting there requires something most people don't have: the ability to be boring for years. This is when compounding stops being a concept and starts being a reality. You can see in your account. There's a number that changes everything. $100,000. Not because it's magic, not because it unlocks some secret investment opportunity, but because of what it represents. The moment when mathematics finally starts working in your favor instead of against you. Most people never reach it. They spend their entire lives chasing it, getting close, falling back, starting over, and they never understand why it's so hard. I'm going to tell you why, and then I'm going to show you why the next 900,000 comes faster than you think. Why going from 100,000 to 1 million is easier than going from 0 to 100,000. Not slightly easier, dramatically easier. This isn't motivational talk. This is mathematics, and if you understand it, really understand it, it'll change how you think about money forever. Let me start with a truth that nobody wants to hear. Your first $100,000 is a grind, a brutal, exhausting, demoralizing grind, and it should be. Because you're not just building wealth, you're building the infrastructure for wealth. The habits, the discipline, the systems, the psychological fortitude to do boring things consistently when everyone around you is chasing excitement. That's what the first 100,000 teaches you, and most people fail the test. I see young people today trying to skip this phase. They want to go straight to the million. They're buying lottery tickets disguised as investments, meme stocks, crypto with no fundamentals, options they don't understand, anything that promises to turn 1,000 into 100,000 overnight. And they lose every single time. Not because those assets can't go up. Some of them do, but because they haven't built the foundation. They don't have the discipline to hold through volatility. They don't have the patience to let probabilities play out. They don't have the emotional control to stick with a plan when it's not working. So they chase. They panic. They switch strategies every month, and they never accumulate anything. The first 100,000 isn't about finding the perfect investment. It's about proving to yourself that you can save, that you can delay gratification, that you can ignore the noise and stick to a system even when it's boring. It's a test of character disguised as a financial goal. Here's what makes it so hard. At the beginning, your contributions matter more than your returns. Let me say that again, because it's critical. When you're starting out, how much you save matters infinitely more than what return you get. If you have $10,000 and you earn 10% in a year, you made $1,000. That's nothing. You can save more than that by cutting expenses, by working extra hours, by being disciplined about where your money goes. But people obsess over returns. They spend hours researching stocks, trying to pick winners, optimize their portfolio, squeeze out an extra 2%, and meanwhile, they're not saving enough. They're not increasing their contributions. They're focused on the wrong variable. I made this mistake early. I thought I was smart enough to pick better investments than everyone else. And maybe I was. But it didn't matter because I didn't have enough capital for it to compound into something meaningful. The math is simple but brutal. Small amounts of money don't grow fast, even with great returns. That's just reality. $1,000 at 20% annual returns for 10 years becomes about $6,000. That's good, but it's not life-changing. It doesn't create momentum. It doesn't feel like you're making progress. So people get discouraged. They think investing doesn't work. They stop contributing. They give up right before the math starts working in their favor. This is the wall, the psychological wall that stops most people. The phase where effort feels disproportionate to results, where you're saving aggressively and investing consistently, and the balance still feels small, still feels like it's not enough. You need to push through that feeling, because something extraordinary happens at $100,000. The returns start mattering. 10% of 100,000 is $10,000. That's real money. That's a number you can feel. That's what you might save in an entire year. Now your money is working as hard as you are. At $200,000, 10% is $20,000. Now your money is working harder than you are. It's earning more in a year than most people save. And it's doing it automatically. While you sleep, while you're at work, while you're living your life. This is when compounding stops being a concept and starts being a reality. You can see in your account. But you have to get there first. And getting there requires something most people don't have. The ability to be boring for years. No shortcuts, no gambles, no get-rich-quick schemes, just consistent saving, consistent investing, month after month, year after year, even when it feels like nothing is happening. That's the real challenge of the first 100,000. It's not technical. It's not about finding alpha or beating the market. It's about discipline, about proving you can do something simple repeatedly without getting distracted. Most people can't. They need excitement. They need to feel smart. They need wins they can talk about. So they chase, they trade, they take risks they don't understand, and they never build the foundation. I didn't get wealthy by being exciting. I got wealthy by being systematic, by doing boring things consistently, by understanding that in the beginning my behavior mattered more than my brilliance. Save aggressively, invest automatically, ignore the noise, repeat. That's the formula for the first 100,000. It's not sexy, it's not fun, but it works. And once you prove you can do it, everything changes. Because the next 900,000 doesn't require more discipline, it requires less. The math takes over, compounding does the heavy lifting. Your money starts multiplying itself, but only if you build the foundation first. When you have $100,000 invested at 10% annual returns, you make $10,000 that year. But that's not the interesting part. Let me show you the math. That changes everything. And the interesting part is what happens next. Year 2, you're not earning 10% on 100,000 anymore. You're earning it on 110,000. That's $11,000. You made an extra 1,000 just from last year's gains compounding. This is compound interest. Everyone knows about it. Everyone's heard the Einstein quote or whatever version of it is floating around. But knowing about it and feeling it are completely different things. Year 3, you're 121,000. Your returns are 12,100. Another increase without you doing anything. And once you cross that threshold, the mathematics start working for you in a way they never did before. For the first 5 or 10 years of your investing life, you don't feel it. The numbers are too small. The effect is too subtle. You're adding money every month and the gains feel incremental. It just looks like you're saving. But somewhere around $100,000, something shifts. The returns become visible, tangible, real. Let's say you're saving $2,000 a month. That's $24,000 a year. Aggressive for most people, but achievable if you're disciplined. You invest it in a broad market index. Nothing fancy, just consistent exposure to equity returns. Historically, that's about 10% annually over long periods. Some years more, some years less. But 10% is a reasonable assumption for this exercise. Let me give you concrete numbers, because this is where most people's intuition breaks down. In your first year, you contribute $24,000 and earn maybe $1,200 in returns. Your balance at the end of year 1 is around $25,000. Year 2, you add another $24,000. Your starting balance is $25,000. You're adding $24,000 more, and now you're earning returns on a larger base. End of year 2, you're at around $54,000. Doesn't feel like much. You saved almost all of that. The market barely contributed. This took you 4 years. 4 years of saving $2,000 a month. 48 months of discipline. That's the grind. That's the part that breaks most people. Still feels like you're doing all the work. The returns are a few thousand, nice but not transformative. Year 3, you're at around $88,000. Year 4, you cross $100,000. You're now at around $127,000. But watch what happens next. Year 5, you're 164,000. Year 6, 207,000. Year 7, 258,000. Notice something. The jumps are getting bigger. Not because you're saving more. You're still putting in the same 24,000 a year. But the returns are growing because the base is growing. Let me show you the math. That changes everything. And when you have $100,000 invested at 10% annual returns, you make $10,000 that year. But that's not the interesting part. The interesting part is what happens next. Year 2, you're not earning 10% on 100,000 anymore. You're earning it on 110,000. That's $11,000. You made an extra 1,000 just from last year's gains compounding. Year 3, you're 121,000. Your returns are 12,100. Another increase without you doing anything. This is compound interest. Everyone knows about it. Everyone's heard the Einstein quote or whatever version of it is floating around. But knowing about it and feeling it are completely different things. For the first 5 or 10 years of your investing life, you don't feel it. The numbers are too small. The effect is too subtle. You're adding money every month and the gains feel incremental. It just looks like you're saving. But somewhere around $100,000, something shifts. The returns become visible, tangible, real. And once you cross that threshold, the mathematics start working for you in a way they never did before. Let me give you concrete numbers because this is where most people's intuition breaks down. Let's say you're saving $2,000 a month. That's $24,000 a year. Aggressive for most people, but achievable if you're disciplined. You invest it in a broad market index. Nothing fancy, just consistent exposure to equity returns. Historically, that's about 10% annually over long periods. Some years more, some years less. But 10% is a reasonable assumption for this exercise. In your first year, you contribute $24,000 and earn maybe $1,200 in returns. Your balance at the end of year 1 is around $25,000. Doesn't feel like much. You saved almost all of that. The market barely contributed. Year 2, you add another $24,000. Your starting balance is $25,000. You're adding $24,000 more, and now you're earning returns on a larger base. End of year 2, you're at around $54,000. Still feels like you're doing all the work. The returns are a few thousand, nice but not transformative. Year 3, you're at around $88,000. Year 4, you cross $100,000. You're now at around $127,000. This took you 4 years. 4 years of saving $2,000 a month. 48 months of discipline. That's the grind. That's the part that breaks most people. But watch what happens next. Year 5, you're 164,000. Year 6, 207,000. Year 7, 258,000. Notice something. The jumps are getting bigger. Not because you're saving more. You're still putting in the same 24,000 a year. But the returns are growing because the base is growing. By year 10, you're at 418,000. By year 15, you're at 835,000. By year 20, you're at 1.5 million. Same contributions, same discipline, but the results accelerate. This is why the first 100,000 is the hardest. You're doing all the work. After that, the math starts doing work for you. And the bigger your base gets, the more work the math does. Here's another way to think about it. To get from 0 to 100,000, you might need to save 80 or 90,000 of it yourself. The market only contributes 10 or 20,000. But to go from 100,000 to 1 million, you might only need to contribute 300,000. The market contributes the other 600,000. Same effort, wildly different results. That's the power of the base. Now here's what most people miss. They look at these numbers and think it's about time. They think, well, I just need to wait 20 years. Set it and forget it. That's partially true. Time is the most important variable once you have capital, but it's not the only variable. The other variable is behavior. And behavior is what kills most people's compounding before it ever gets started. Because here's what happens in reality. You're in year 3. You have $88,000. The market drops 20%. Now you have $70,000. You just lost $18,000. That's almost a full year of contributions. You worked for 12 months to save that money, and the market erased it in 6 weeks. How do you feel? Angry, scared, like you're going backwards, like investing is a scam. Every instinct tells you to stop, to sell, to protect what's left. And if you do that, you break the compounding. You reset the clock. You turn a temporary loss into a permanent one. This is the test, not year 1 or year 2, but year 3 or 4, when you finally have something to lose and the market takes it away. Most people fail this test. They sell at the bottom. They stop contributing. They switch to something they think is safer. Cash, bonds, gold, anything that feels less volatile. And they never recover, because by the time they feel safe enough to get back in, the market has already recovered. They miss the rebound. They miss the compounding. They're stuck in the grind forever, restarting, rebuilding, never getting past that 100,000 mark. I've seen this pattern destroy more wealth than any market crash ever could. It's not the crash that ruins people, it's their reaction to it. This is why I keep saying the first 100,000 is psychological as much as mathematical. It's not just about accumulating capital. It's about learning to hold capital through volatility. If you can do that, if you can see your balance drop by 20 or 30% and not panic, not sell, not change your strategy, then you've passed the test. And once you pass it, the math works exactly like I described. The compounding accelerates. The returns grow. The momentum builds. But you have to stay in the game. You have to let the mathematics play out. You have to trust the process, even when every emotion in your body is screaming at you to do something. That's the real skill. Not picking stocks, not timing the market, not finding the next big thing, just staying invested, staying disciplined, staying boring. Do that for 10 years and you'll have more money than you thought possible. Do it for 20 and you'll be wealthy. Not because you're brilliant, but because you didn't interrupt the compounding. There's a statistic that haunts the investment industry, but nobody talks about it. The average equity fund returns about 10% annually over the long term. That's the number you see in the performance reports, the number they advertise. But the average investor in those funds makes about 4%. Think about that. The fund makes 10. The investor makes 4. Same fund, same time period, different results. How is that possible? Behavior. Investors buy high when they feel confident. They sell low when they're scared. They chase performance. They panic during crashes. They get in and out at exactly the wrong times. They turn a winning strategy into a losing one purely through their own actions. This is called the behavior gap, and it's the single biggest destroyer of wealth in the market. Bigger than fees, bigger than taxes, bigger than picking the wrong stocks. Your behavior will determine your results more than anything else. And most people's behavior is terrible. I learned this not from investing, but from building systems. Systems don't have behavior problems. They don't panic. They don't get greedy. They execute exactly as programmed, regardless of what's happening around them. That's their advantage. Not intelligence, consistency. Consistency, humans can't compete with that. We're wired for survival, not for investing. Our brains evolved to avoid threats, to react quickly, to trust our instincts. All of that works against us in markets. When the market drops, every fiber of your being tells you to run, to protect yourself, to get out before it gets worse. That instinct kept our ancestors alive. It kept them from getting eaten by predators. But in markets, it destroys you, because markets don't work like predators. They're not trying to kill you. They're just oscillating, going up and down based on millions of independent decisions. And the volatility that feels dangerous is actually the source of returns. You get paid for enduring volatility, not for avoiding it. But most people can't do this. They see their account balance drop and they feel physical pain. Actual stress, Loss aversion is one of the most powerful cognitive biases we have. Losing $1,000 hurts more than gaining $1,000. Feels good. So we make irrational decisions. We sell assets that are down to stop the pain. We hold assets that are up because they feel safe. We do exactly the opposite of what we should do. Buy low, sell high. Everyone knows this. It's the simplest rule in investing, and almost nobody follows. They buy high because that's when things feel safe. When everyone else is buying, when the news is good, when momentum is up, it feels right. They sell low because that's when things feel dangerous. When everyone else is selling, when the news is bad, when momentum is down, it feels necessary. And they lose money doing the thing they knew they shouldn't do. This is the behavior gap. And it's why the first 100,000 is so important. Not because of the money itself, but because of what you learn getting there. You learn to ignore your instincts, to act counter to your emotions, to trust systems over feelings. If you can save $2,000 a month for 4 or 5 years, you've proven you can delay gratification, that you can prioritize future you over present you, but you won't spend just because you have money available. That's discipline. If you can hold through a market crash without selling, you've proven you can endure pain without reacting, that you can distinguish between temporary volatility and permanent loss, that you won't sabotage yourself when things get uncomfortable. That's emotional control. If you can stick with a boring strategy, when everyone around you is making money on something exciting, you've proven you can resist FOMO, that you won't chase performance, that you can be patient even when it feels like you're missing out. That's maturity. These are the real skills, and you can't learn them from a book. You have to earn them. You have to go through the experience, feel the emotions, make the choice to act rationally anyway. The first 100,000 is your training ground, your crucible, the place where you either develop these skills or you don't. And if you don't, the next 100,000 won't matter, because you'll sabotage it, you'll sell at the bottom, you'll chase the wrong things, you'll let emotion override logic. I see this constantly. People who finally accumulate some capital, 50,000, 75,000. Then they hear about some opportunity, some hot stock or crypto or real estate deal, and they convince themselves this is how they'll accelerate. They take what they've built through discipline and they gamble it on something they don't understand. Because patience feels too slow because they want the shortcut, and they lose it. Not all of it, usually, but enough that they're back to square one, back to rebuilding, back to the grind. They had the capital, they just didn't have the behavior. This is why I keep emphasizing systems. Systems remove behavior from the equation. They make decisions based on logic, not emotion. They execute consistently regardless of market conditions. You don't need a sophisticated system. You need something simple that you can actually follow. Contribute a fixed amount every month, invest in diversified assets, rebalance once a year. Don't look at your account more than quarterly. That's it. That's the system. So boring it hurts. But boring works. Boring compounds. Boring gets you to 100,000 and then to 1,000,000. Exciting loses. Exciting chases. Exciting reacts. The behavior gap exists because people can't accept boring. They need to feel smart. They need to feel active. They need to feel like they're doing something. So they trade, they adjust, they optimize, they convince themselves they're improving their strategy, when really they're just introducing more opportunities to make mistakes. Every decision is a chance to be wrong. Every trade is a chance to buy high or sell low. Every adjustment is a chance to break what's working. The more you do, the more you risk sabotaging yourself. This is counterintuitive. We're trained to believe that effort equals results, that more action leads to better outcomes, that if we're not doing something, we're falling behind. In investing, the opposite is true. Less is more. Inaction is action. Holding is harder than trading. The best investors I know do almost nothing. They built a system, they trust it, they let it run, they resist the urge to interfere. That restraint is more valuable than any analysis, any research, any insight, because the returns are already there. The market delivers them over time. Your job is just not to get in the way, not to interrupt the compounding with your behavior. If you can master that, if you can be boring and patient and disciplined for 5 or 10 years, you'll reach that 100,000. And once you're there, the math takes over. The behavior matters less because the momentum is on your side. The returns are large enough to feel real. The compounding is visible. But you have to get there first. And the only way to get there is to manage yourself. Something remarkable happens when you cross $100,000. The game changes. Not subtly, fundamentally. Up until that point, you've been pushing a boulder uphill. Every dollar requires effort. Every month requires discipline. You're fighting inertia, fighting your own psychology, fighting the math that makes small numbers stay small. But at 100,000, the boulder reaches the top of the hill, and physics takes over. Now it's rolling downhill, building momentum. You're still contributing, still being disciplined, but you're no longer doing all the work. The money is working with you now, working for you. This is the acceleration point, and most people never experience it because they quit before they get there. Let me show you exactly what I mean with real numbers. You've saved aggressively and reached $100,000. You're still contributing $2,000 a month, $24,000 a year. The market gives you 10% annually. In year one, after hitting 100,000, your returns are about 10,000. Your contributions are 24,000. Total gain is 34,000. You end the year at 134,000. Your contributions still matter more. You added 24, the market added 10. You're still the primary driver. But watch what happens as the base grows. Year two, you're starting with 134,000. Returns are 13,400. Contributions are still 24,000. Total gain is 37,400. You end at 171,000. Year three, returns are 17,100. Still adding 24,000, total gain is 41,100. You're at 212,000. Notice the returns are climbing, 13,000, 17,000. Next year will be 21,000. The year after, 25,000. By year five, after crossing 100,000, your annual returns match your annual contributions. Both around 24,000. You're at 50-50. You and the market are equal partners. That's the inflection point. From here forward, the market does more work than you do. Year six, returns are 29,000. You're contributing 24,000. The market is out earning you now. Year 10, returns are 47,000, nearly double your contributions. Your money is working twice as hard as you are. Year 15, returns are 93,000, almost 4 times your contributions. Your money is doing work you could never do through salary alone. This is the acceleration. And it doesn't stop, it intensifies. By the time you reach 500,000, which happens around year 12, your 10% returns are 50,000 a year. That's more than most people make in salary. You're earning an entire middle-class income from your investments while still working your job. At 750,000, you're earning 75,000 a year in returns. At 1 million, you're earning 100,000. Your money has become a second job. Except this job works 24 hours a day, never takes vacation, never gets tired, never asks for a raise, just compounds. This is what people don't understand when they're starting out. They see someone with $1 million, and they think that person must have saved $1 million, must have made incredible sacrifices, must have had a massive income. Sometimes that's true, but often it's not. Often they just started early enough and stayed consistent long enough that the math did most of the work. They contributed 300,000 or 400,000 over 20 years. The market contributed 600,000 or 700,000. Compounding built the wealth. They just didn't interrupt it. This is why time is the most valuable asset when you're young. Not because you'll save more, but because you give compounding more years to run, more cycles to multiply. Starting at 25 versus 35 doesn't mean you save 5 more years of contributions. It means you get 5 more years of compounding on everything you'll ever save. Those 5 years at the beginning are worth more than 10 years at the end. Because at the beginning, those years compound for decades. At the end, they compound for a few years before you need to use the money. Every year you wait to start costs, you exponentially, not linearly, exponentially. This is mathematical reality, not opinion, not motivation, just math. But here's what makes the acceleration even more powerful. You don't have to stick with $2,000 a month forever. As you get older, you earn more. You get promoted. You develop skills. Your income grows. If you maintain the same savings rate, your contributions grow too. Maybe by year 10, you're saving $3,000 a month instead of $2,000. That extra $1,000 doesn't just add $12,000 a year. It adds $12,000 that will compound for the next 10 or 20 or 30 years. Every increase in contribution gets magnified by all the time it has left to compound. This is how people go from comfortable to wealthy, not through dramatic moves, through steady increases in contributions, combined with relentless compounding. You start at $2,000 a month. 5 years later, you're at $2,500. 5 years after that, $3,000. By the time you're 45, you're saving $4,000 a month. And all of it is compounding on a base that's already substantial. The wealth builds faster than you expect. Not because you're making brilliant investments, but because you're feeding a machine that runs on mathematics. And the bigger the machine gets, the more output it produces from the same input. This is the secret wealthy people know that broke people don't. Past a certain point, your income doesn't matter as much as your assets, because assets compound. Income doesn't. If you make $100,000 a year, you make $100,000 a year, every year. Same number. You can spend it or save it, but it doesn't grow on its own. But if you have $1 million invested at 10%, you make $100,000 a year without working. And next year, you don't make $100,000 again. You make $110,000, then $121,000. Your asset income grows automatically. Your salary income doesn't. This is why the first $100,000 matters so much. It's the foundation of the machine, the base that everything else builds on. Once you have it, once you prove you can build it, the rest becomes easier. Not easy, but easier. The math starts working for you instead of against you. And if you keep contributing, keep being disciplined, keep letting it compound, the acceleration becomes almost absurd. I've watched this happen to people over decades. They start with nothing, grind through the first 100,000. Then suddenly they blink and they're at 300,000. Blink again and they're at 700,000. One more blink and they're millionaires. It feels like magic, but it's not. It's just compound interest finally having enough capital to show what it can do. The boulder rolling downhill, picking up speed, becoming unstoppable. You just have to push it to the top first. Here's what nobody tells you about wealth. The most important part is invisible. When someone has $1 million, you can't see it. They don't look different. They don't dress differently. They don't drive a better car or live in a bigger house. At least the smart ones don't. The dumb ones convert their wealth into status symbols. They turn their million into a car, a watch, a lifestyle. They make it visible. And in doing so, they destroy it. Because wealth and status are inversely correlated. The more you display, the less you have. The less you display, the more you accumulate. This is another lesson the first 100,000 teaches you. If you're saving $2,000 a month, you're not spending it. You're not buying the new phone. You're not upgrading your car. You're not going on expensive vacations. You're being boring, invisible, unremarkable. And that bothers people. Humans are social creatures. We care what others think. We want to signal success. We want recognition. So we buy things not because we need them, but because they communicate something about us to the world. They say, we've made it, we're successful, we're winning. But every dollar you spend signaling status is a dollar that can't compound. It's a dollar you took out of the machine. And not just $1, it's that dollar plus all the future returns it would have generated. A $5,000 watch doesn't cost $5,000. It costs $5,000 plus the $50,000 that money would have become over 20 years. It costs $100,000 in opportunity cost. That's the real price. And most people never calculate it. They see a $5,000 watch as $5,000, 1 month of savings, affordable if they really want it. So they buy it, and they're right. It is affordable, but it's expensive in a way they don't see. It's expensive in compound interest, in momentum, in the acceleration they just interrupted. This is why most people never reach 100,000. Not because they can't save, but because they can't stop spending on things that don't matter. They make 70,000 a year and spend 68,000. They make 100,000 and spend 95,000. Their spending scales with their income. Their savings stay flat. They're on a treadmill, running faster every year, but never getting anywhere. The people who reach 100,000 and then 1,000,000 do something different. They increase their income, but they don't increase their lifestyle proportionally. They maintain a gap, and they invest that gap. This is called lifestyle inflation resistance, and it's more valuable than any investment strategy. You get a $10,000 raise. Most people spend 9,000 of it, maybe save 1,000. Their life gets slightly better, slightly more comfortable, but their trajectory doesn't change. Smart people save 7,000 of it. Spend 3,000, their life still improves. But now they're accelerating, they're feeding the compound interest machine more fuel. And that fuel will multiply for decades. One decision, $10,000 a year. Over 20 years with compounding. That's not 200,000, it's closer to 600,000. One decision created 600,000 in wealth. That's what invisible wealth looks like. It's every small decision you make to delay gratification, to prioritize future you over present you, to value compounding over consumption. Nobody sees those decisions. Nobody applauds you for driving a 10-year-old car, or for skipping the vacation, or for living in a smaller apartment than you can afford. You look exactly the same as someone who's broke, maybe worse, because the broke person might have nicer things. They might look more successful. But you're building something they're not. You're building a machine that will run for decades, that will produce wealth long after the new car has depreciated and the vacation has been forgotten. This is the fundamental trade-off. Visible success now, or invisible wealth later. Most people choose visible success because it feels better, because it gets recognition, because it satisfies the ego, and they spend their whole lives looking successful while being broke. The millionaires I know, the real ones, not the ones pretending, they're invisible. They drive normal cars. They live in normal houses. They wear normal clothes. You'd walk past them on the street and never know, because they understand something most people don't. Wealth isn't about what you spend. It's about what you keep, what you compound, what you let grow without touching. Every dollar you keep invested is a soldier fighting for your future. Every dollar you spend is a soldier you've discharged, sent home, taken out of the battle. The more soldiers you keep fighting, the faster you win. This metaphor sounds dramatic, but it's accurate. Your money is either working for you or it's not. There's no middle ground. It's either in the market compounding or it's spent and gone forever. Most people discharge most of their soldiers. They keep a small army, just enough to feel like they're investing, but not enough to build real wealth. They save 10%, spend 90%, and they wonder why they're not getting ahead. The people who build wealth save 30, 40, 50%. They live on less than they make, way less, and they invest the difference aggressively. It's not complicated, it's just hard because it requires sacrifice, real sacrifice. Not the fake sacrifice of skipping your daily coffee, but the real sacrifice of living in a smaller place, driving an older car, not going on expensive trips, The sacrifice of being invisible while everyone around you is trying to be visible. That's the price of the first 100,000. And most people aren't willing to pay it. They want wealth, but they want the lifestyle too. They want to invest, but they also want to enjoy their money. They want to compound, but they also want to spend. You can't do both. Not at the beginning. Not when you're building the base. Later, when you have $1 million or $2 million or $5 million, you can relax, you can spend some of the returns, you can enjoy the fruits of compounding, because the machine is big enough to support both growth and spending. But at the beginning, you have to choose, and if you choose wrong, you stay broke forever. This is why I keep coming back to the first 100,000. It's not about the number. It's about what the number represents. The discipline, the sacrifice, the willingness to be invisible while you build something real. If you can do that for 5 or 10 years, you'll have more wealth than 90% of people. Not because you're smarter, not because you earn more, but because you valued compounding over consumption. Because you understood that wealth is invisible, and you were willing to look boring while you built it. When I was starting out, there were fewer ways to lose money. You could buy stocks, buy bonds, maybe some real estate. That was about it. The options were limited. The noise was manageable. The world today makes it harder than ever to build wealth. Not because opportunities don't exist, but because distractions are everywhere. Today, you have infinite choices. Crypto, NFTs, options, Forex, SPACs, day trading apps, meme stocks, AI tokens. New investment vehicles are created every month, each one promising to be the shortcut, the hack, the way to skip the grind. And people believe it because they want to believe it. It's not. Those are lottery tickets. And for every winner you see, there are 10,000 losers you don't. They see someone on social media turn 10,000 into 1 million trading options, or someone who bought Bitcoin early, or someone who flipped NFTs, and they think that's the path. And it distorts your perception of reality. You start to think that slow and steady is for suckers, that saving $2,000 a month for 10 years is outdated advice, that there has to be a better way. But the losers don't post. They don't share their stories. They don't make videos about how they lost everything trying to get rich quick. So all you see is the wins, the highlights, the anomalies. There isn't. The principles haven't changed. Spend less than you earn. Invest the difference. Let it compound. Stay disciplined. Be boring. That's still the formula. The only formula that works consistently across time and market conditions. But it's harder to follow now because you're bombarded with alternatives, with stories of people who made it faster, with FOMO that eats at you every day. You're watching your portfolio grow by 10% while someone on Twitter claims they made 300% on some token you've never heard of. And it makes you question everything. Maybe you're doing it wrong. Maybe you're too conservative. Maybe you should take more risk. I've seen this cycle destroy countless people over the last decade. They had the discipline. They were building wealth. Then they got distracted. They chased, they gambled, and they gave it all back, and you lose it, or most of it. And you're back at the beginning. And if you listen to that voice, you lose. You take money out of your boring index fund, and you put it into something exciting, something with potential, something that could moon. The market didn't beat them. They beat themselves. And the solution is the same as it's always been. Ignore it. This is the modern trap. Infinite options, infinite noise, infinite opportunities to sabotage your own progress. Turn off the financial social media. Stop checking your portfolio every day. Stop reading about the next big thing. Just contribute. Just invest. Just let it compound. Be so boring it hurts, because the alternative is constant temptation, constant comparison, constant second guessing. They're gambling, and gambling sometimes pays off, but usually it doesn't. And even when it does, the gambler can't stop. They take their winnings and they gamble again, and eventually the house wins. You're building wealth at 10% a year, and someone else claims they're building it at 50%. So you feel like you're losing, like you're falling behind, like you're missing out. But you're not. You're doing exactly what you should be doing. You're compounding, you're building a foundation, you're making decisions that will matter in 20 years. You're not gambling. You're investing. There's a difference. Investing is boring. It's predictable. It's based on historical averages and mathematical certainty. You know roughly what to expect. 10% a year, some years more, some years less. But over decades, it averages out. Gambling is exciting. It's unpredictable. It's based on hope and luck. You don't know what to expect. You could double your money. You could lose everything. And that uncertainty is addictive. Most people can't resist it. They need excitement. They need the possibility of a big win. They need to feel like they're doing something special. And that need costs them everything. The people I know who've built real wealth, the kind that lasts, they're all boring. Every single one. They found a strategy that works. They stuck with it. They ignored everything else. And now they're millionaires. Not because they were brilliant, but because they were consistent. That's harder now than it's ever been. The noise is louder. The distractions are shinier. The temptation to do something different is constant. They didn't chase crypto in 2017. They didn't buy GameStop in 2021. They didn't panic sell in 2022. They just kept contributing, kept investing, kept compounding. But the reward for resisting is the same. Wealth, real lasting compound-driven wealth. You have to save, and you have to stay the course. You have to build the base, and you have to protect it from yourself. Here's what I want you to understand. Getting to $100,000 requires discipline, but getting from 100,000 to 1 million requires discipline plus resistance to distraction, because the biggest threat to your wealth isn't the market. It's you, your emotions, your FOMO, your need for excitement, your inability to accept boring. But it requires saying no, constantly. No to the new crypto. No to the hot stock tip. No to the trading strategy your friend is using. No to options. No to leverage. No to everything that isn't part of your boring, simple, proven plan. If you can control that, if you can be disciplined and patient and resistant to every shiny object that comes your way, you'll build more wealth than you ever thought possible. That's the truth. Nobody wants to hear. Because it's not exciting, it's not sexy, it's not the story you can brag about at parties. Say no for 10 years and you'll be wealthier than most people who said yes. But it's the truth. And if you follow it, you'll win. I'm 86 years old. I've built wealth that most people can't imagine. And I'm going to tell you something that might disappoint you. It wasn't special. There was no moment of genius, no secret formula, no insider knowledge, just mathematics applied consistently over decades. The same mathematics available to anyone, the same strategy you could execute starting today. The only difference is time and discipline. That's it. That's the whole story. But people don't want to hear that. They want the secret, the trick, the shortcut. They want to believe there's something they're missing, some piece of knowledge that, once revealed, will change everything. There isn't. The path from 0 to 100,000 to 1 million is completely transparent. Save aggressively, invest consistently, let it compound, don't interrupt it. That's the entire formula. You already knew that before you started reading this. And yet most people won't do it. Not because they can't, but because it's too simple, too boring, too slow. They want wealth, but they don't want to wait. They want compounding, but they don't want to be patient. They want the results without the process. And so they stay broke, or they stay middle class, or they build a little wealth and then destroy it, chasing something faster. The quiet victory is available to anyone. But almost nobody claims it, because claiming it requires becoming someone most people can't become, someone who can delay gratification for years, someone who can watch their friends spend while they save, someone who can endure volatility without panicking, Someone who can be invisible while everyone around them is trying to be seen. That's the price. And it's higher than most people are willing to pay. Not in money, in ego, in patience, in the willingness to do boring things consistently when there's no immediate reward. I built Renaissance technologies on this principle. We didn't try to be the smartest. We tried to be the most consistent. We removed emotion. We removed discretion. We built systems that just executed day after day, year after year. And we compounded at rates people said were impossible. The same principle applies to personal wealth. You don't need to be a genius. You need to be a machine, a boring, consistent, emotionless machine that saves and invests and compounds without deviation. If you can do that for 10 years, you'll reach 100,000. If you can do it for 20, you'll reach 1 million. If you can do it for 30, you'll be wealthier than you ever needed to be. The math is certain. The only variable is you. Can you stay disciplined when it's boring? Can you stay patient when it's slow? Can you stay invested when it's scary? Can you resist distraction when it's everywhere? If you can answer yes to those questions, you'll win. Not maybe, not probably. You'll win. The mathematics guarantee it. But most people will answer no. And they'll spend their lives wondering why wealth never came, why they're still struggling, why everyone else seems to have it figured out. They'll blame the system, the economy, their income, their circumstances, anything except the real reason. They couldn't control themselves. That's the hard truth, the brutal truth, the truth nobody wants to acknowledge. Wealth isn't complicated. It's just hard. Hard to save when you want to spend, hard to wait when you want results now, hard to be boring when you want to be interesting. But the people who do it, who push through the discomfort and the doubt and the FOMO, they're the ones who win. And their victory is quiet. There's no fanfare, no recognition, no moment where the world acknowledges what they've built. They just wake up one day and realize they have $1 million, 2 million, 5 million, and they got there by doing nothing special, nothing remarkable, just small, boring, consistent actions, repeated over time. That's the victory I'm talking about, the one that's available to you right now, today, this moment. You don't need permission. You don't need a degree. You don't need connections or luck or genius. You just need to start and then not stop. Save what you can, invest it, simply let it grow, ignore everything else. Do that until you reach 100,000, then keep doing it. Because once you cross that threshold, the math takes over, the compounding accelerates, the momentum builds, and before you know it, you're not pushing the boulder anymore. You're riding it, you're watching your wealth grow faster than you ever thought possible. Not because you got smarter, but because you gave compounding enough capital and enough time to do what it does. This is my final lesson. After 40 years of beating Wall Street, after building one of the most successful funds in history, after accumulating more wealth than I'll ever spend, the secret isn't secret at all. It's just boring. So boring that most people ignore it. So simple that most people think it can't work. But it does work. It's always worked. It will always work. The first 100,000 is the hardest. The next million is automatic. Not easy, but automatic. The math does the work. The math does the work. You just have to let it. That's the quiet victory, and it's waiting for anyone disciplined enough to claim it.